Welcome to the daily update, where I'll go over the action in the market for Monday, March 17th, and we'll see how things look for Tuesday, March 18th. Okay, we had a nice bounce on Friday with 90% up volume. We had another bounce on Monday. Most of the volume was to the upside. I think it was another 90% up day there. I have a chart to show you that later on. But we have not switched back over to positive yet. There's a lot of damage that was done as we've been coming down. If we continue to go up, we'll be watching different levels for overhead resistance, and I'll try to point that out as we go along. We're not seeing really any improvement of the growth to value ratios. We need growth to come in and take a leadership role. It's holding up, but it's not outperforming value right now. And that's a little bit of a concern too. Okay, so right at the open, we had a higher open, and we initially hit resistance at R1, which was at 56.58. Then we declined back down to the unchanged level, and that is typical. When we have our pivot points for the day, we have R levels when we're going up, we have S levels when we're going down. A built-in support or resistance level is the unchanged level. We came right back down to that level, and then prices remained positive. We stayed above the unchanged level. And then later in the day, this is encouraging. The buying picked up speed and we were able to climb above R1 this time, where earlier in the day it acted as resistance. Then we hit resistance at R2 at 56.97. And then we bumped a little bit above that. We hit the 5,700 level before dropping back down to close above R1. So we closed off the high, but it was a positive day. We're seeing things show signs of improvement, but not switching back over to positive. We were up 0.64% on below average volume. This is another concern. The two bounce days that we've seen, Friday and Monday, both of those were on below average volume. And that is a classic technical analysis negative divergence. We've been above average with volume as we were coming down. Now we're bouncing back up on below average volume. That is a concern. And we're still negative in the short intermediate term. We're mixed in the long term because we're still below the 200-day moving average. Interest rates were virtually unchanged on the day. We had the big retail sales report that came out, and I'll talk about that. And a lot of it has to do with tariffs and Doge and all the changes that are going on with the new administration. Some comments that we can make here. The newly confirmed U.S. Trade Representative Greer, I don't know, is that a football player? Rosie Greer, aims for a more orderly rollout of reciprocal tariffs on April 2nd. Okay, now that's just a statement. We don't know how things are actually going to go, but the market kind of liked that and said, okay, if we're going to have these tariffs, we're not just going to slap them on and not give anybody a warning. We're just going to say, okay, this is going to take effect here and there and at this time. So the market kind of liked that. Oil prices did rise. We're still at lower levels. We're still just into the mid to upper 60s, but there has been an increase in geopolitical tensions after President Trump warned Iran that any further attacks by the Houthi rebels on U.S. vessels will be looked upon as a shot fired from the weapons and leadership of Iran. Okay, so things might be heating up there. Now, they've been not very good since, what was it, 1979? Iran and the U.S. used to be good friends, and they had the Shah of Iran there, and then he had to leave. And then you had the Ayatollah Khomeini come in. I grew up during this time, so I remember it well. And they didn't like Western values. They really didn't like the U.S. They don't like Israel. And it's been a pretty big problem ever since then. Now, we are coming down with the VIX, but we're still above 20. We're at 20.51, so that's lower than we have been, but we're still above 20. And this is encouraging, though. The parabolic SAR has now turned positive, and our short-term list is getting even a little bit shorter. We're still looking at the short-term ADX. That measures the condition of the trend. It's above 40, and we really just noticed that, and it's rolling over just a little bit, and I'll show you the chart of that. We're still looking extreme with the stochastics and the slope oscillator, and we're still far away from the 20 period moving average. That's how quickly we went down. In the intermediate term, we're also still far away from the 50 period moving average, and the TTM squeeze is extreme negative. We still have a non-confirmed Hindenburg Ullman. We need two spikes. We've only seen one spike. We need to have another spike occur by March, either on or before March 31st. If that happens, then it's confirmed, and that's a negative signal, but it hasn't happened yet. No changes to the overall scenario as it concerns the Fed. They're going to be meeting on Wednesday, and it's pretty much certain that they're not going to do anything with rates. Over the weekend, I did a video, and it's a 98% chance that they're going to leave rates where they're at right now. But there's the press conference and the statement that they make and the report that they come out with, and the market's going to be dissecting all of those things to try to find some hidden meaning. The dollar was down and interest rates were unchanged. We're at 4.31% with the 10-year yield. We're still below 25 with sentiment. We've been just camped under this level, which is very strange. Usually we come down to around the 25 level, have a washout in the market, turn and go the other way. We've been under 25 now for quite some time. We're at 22. We just ticked up one notch, even with the up day, where we had been at 21 after Friday. And we're not inverted anymore with the 10 to the 3 month yield curve, but it's close. One day could, with things going in a certain direction, and we could easily go back to being inverted again. We're just keeping an eye on that one. As far as our trend, we're still negative. The ADX is above the moving average and going up, and so that shows a strengthening trend. And we're above 20, so it's a confirmed trend. And because we had the up day, the bias is positive, but I'm still treating the last number of days together as negative. That would be the momentum. So the economic reports that came out, weaker than expected. Retail sales were up 0.2% on a month-over-month basis. They expected the report to come out with an increase of 0.7%. Last time it was down 1.2%. But the market seemed to be okay with this. At least it was positive this time. If you take out autos, it was up 0.3% month over month. They expected 0.4%. Last month it was down 0.6%. And the New York Fed's Empire Manufacturing Survey came in at a minus 20. Last time it was at 5.7. And anytime we get a number below zero, it shows contraction in the New York area. Business inventories came in as expected, up 0.3%. Last time they were down 0.2%. The NAHB Housing Market Index came in at 39. That's less than the 43 they had expected. Also down from the 42 that we saw last time. Okay, so here's some charts. Here's the Empire State Manufacturing Index, which really came down, showing contraction in the New York area. Then the NAHB Housing Market Index, it's really been coming down lately, but it's still it was growing. I mean, we're coming in at 39 here, but it had been a lot stronger. And this could have to do with housing prices are just out of reach for a lot of people, and interest rates going up make it more difficult to get a mortgage. And here's the core retail sales on a year-over-year basis, pretty much flat, but still positive. This is another area that we watch to see, are we going to go into a recession? And this is kind of a concern. Usually we see a flat reading before a recession and before it actually starts to turn down. Month over month, we saw a big decrease in the previous reading. Well, at least we're positive this time, but not quite as much as they had expected. Then looking at this, one of the fastest corrections ever. Now what? Okay, so we came down really quickly here. And so using what they come up with here, 1 month out, when we've fallen from 10% from the all-time high, which is what happened. What happens after that if we start to bounce up? Well, we're a month later, we're up 60% of the time, which is not all that great. It's a little bit over 50-50. 3 months out, it looks a little bit better, up 66% of the time. 6 months out, 70%. 12 months out, almost 74%. So the further out you go, once we come down to a 10% correction and then go up out of that, things tend to get good, but it might not happen right away. Then I've showed this from time to time. This is periodically updated. This looks at the PE ratios of all 11 sectors inside the S&P 500. Right here in this area, this is the S&P PE ratio where it had been up around 22 or so. And because of the declines, it's coming back down to 20. Now, 20 and above, that's considered to be expensive. So we're still expensive that way. If we see more of a deterioration of prices, the PE ratio will keep coming down and get at least more fairly priced. But this just shows the different areas, the sectors of the S&P and what their current PE ratios are. Then big tech's valuations are well off bottoms of past slumps. So when we came down here back in 2018 going into 2019, where we had that mini crash that took place on Christmas Eve, this just shows the valuation really came down and then we bounced up out of that. And then back after the bear market that we saw in 2022, the valuations were really low. We're still coming in at 25. Now you could take that as positive, saying, okay, this is holding up a little bit better. You could also take that as negative, saying that maybe we haven't gone down enough yet. And then what's the average equity positioning right now? We're actually dropping below zero since we're seeing equity positioning coming out of the market a bit. Now, what we're seeing inside of the S&P itself is more rotation. That's why the advanced decline line has been holding up quite well. It's not coming out of the market, it's going from one part of the S&P to another part, growth over to value. But according to this, we're actually seeing some money coming out. And risky versus safe asset fund flows. A lot of things are we're dropping below this line here as we've been going down. That's just shown a real reflection in sentiment right now. Then I thought this was kind of interesting. Trump's trade war compared with his first term with his second term. And there was a big spike here back when he first got elected. Not as much as this time, but there's a little bit of a correlation going on here. Maybe things will get to the point where they actually start to drop down because they're getting more used to what's actually happening. It's, they some sources say there's a new sheriff in town, and yeah, there's always this initial time where you're trying to adjust and figure out, okay, what's the new realities? And they're so different from the previous administration. And of course, you have a lot of people that complain about that. You have other people that really like that, but the market has to adjust to that. Just like at the back in 2016, the election, where the day before the election, the markets had priced in an 80% chance that Hillary was going to win. Well, when that didn't happen, the overnight adjustments that took place were just massive. And I watched all that unfold. I kind of get a kick out of that, watching that stuff. But by the time we opened the next day, things were kind of back to normal. It wasn't that the market was reacting either positively or negatively. They were just reacting to new realities. And so they see Trump as a businessman and the things that he promised when he was running back in 2016 versus what Hillary was saying she was going to do. And so the market needed to adjust to that. Well, now we have things happening so quickly, and the market will eventually adjust to it. We just don't know how long that's going to take or what kind of pain's going to come along the way or what the ramifications are going to be from that. Are we going to go into a recession? Are we going to be able to avoid a recession? The market isn't really sure about that right now. And then this also looks at market performance, where the market held up fairly well, where it's not been holding up all that good now, came through this initial bumpy time and then ended up performing. And then this is all the COVID stuff that happened after that. Okay, and then we look at the three times NASDAQ ETF. Now, I mainly talk about these are called enhanced or juiced ETFs, where if the QQQs or the S&P goes up 1%, these ETFs are designed to go up 3%. We're seeing a lot of money going back into that over the last 2 weeks, and that's pretty hefty. Now, you could take that as positive that there's some confidence that we're going to go up from here. You could take that as negative because these tend to be riskier, and the folks that maybe haven't had as much experience in the market, they're the ones doing this, and we tend to use that more as a contrarian type of indicator. So there's a couple of different ways to read this. And then I'm not going to go through all this here, but the S&P after closing at a 6-month low, then consecutive 90% up days, what happens after that? And that's what we've seen. This was a 6-month low. We broke through the 200-day moving average for the S&P. We had a 90% up day on Friday. We had another one on Monday. And then what happens going forward? And again, the further out you look, the better it looks as far as the percentages of whether we're winning or losing and what the returns are at that point. And this is put out by Edward Yardeni. This is showing the earnings right now. They're still going up. It's like, okay, the memo about a recession, well, we didn't seem to get that. And so we're still projecting earnings looking pretty good going out into the future. Even though those earnings forecasts have lowered a little bit, they're still looking positive looking out. Okay, so here's the intraday chart showing the higher open. We were pretty much flat at the open, and then we bumped up here, hit R1, came back down to the unchanged level. Then later in the day, we kind of drifted higher, and then, as what often happens in the afternoon, this is when we see the smart money come in and say, okay, we're gonna do some buying here, and we're gonna we they took it all the way up to S2. That was also the 5,700 level. And we stalled out at that point, and then we saw some selling going into the close, and we ended up closing a bit off of the high there, but it was still a positive day. We're down about a third of a percent as I started to record this. This is about 8 hours before the market is even getting ready to open. But we were pretty much flat in the initial session that opens Sunday evening. And we did gap lower, but then we started to come back up here and just show a gradual improvement that carried over into the cash session. And this is where we're not seeing much change right now. Now, both the blue line and the red line are going up, but the red line's above the blue line. The red line is value, and we want to see the blue line above the red line, showing that on an intraday basis, growth is outperforming value. We're not seeing that yet. A little bit of an improvement here, not much weakness, but we're kind of going sideways. We had two big up days, Friday and Monday. You would expect this to go up with a little bit more conviction than what we've been seeing right now. On the end of day charts, growth was up, but up a lot less than value. But it was up more for the mid caps, but up less for the small caps. So we're seeing a little bit of a change, but still under the 200-day moving average with our small cap growth to value ratio. A little bit of a bounce, but also below the 200-day moving average with the mid cap growth to value ratio, and barely a move here with S&P growth to value. So really not much of an improvement there and not much of an improvement when we compare the growth versus value ETF on a ratio basis, and not much of an improvement with discretionaries to staples either. So this is not what we're seeing internally is a shift back over to growth. And that suggests that maybe this is just a bounce that's getting ready to go lower after we work off some of this extreme oversold condition that we were in. That's why we're going to be really watching overhead resistance. Like if the S&P gets back up to its 200-day moving average, hits that, turns, and then starts coming down, that could be a signal that maybe we're going to resume going down. We're going to need to get back above those levels for things to turn more positive. Then here is the trend. This is intermediate term. We're rolling over a little bit here, but we're still above the moving average. It's still negative because the red line's above the green line, even though the red line has been coming down. Shorter term rolling over because that acts a little bit quicker, but we haven't crossed below the moving average yet. The red line's coming down, the green line's coming up, but it's still negative. Volume for the last couple of days now has been below average. And I have a chart that I haven't shown here before. This just measures whether we're above or below average with volume for the S&P. You can see Friday was red and Monday was red. And excuse me. So as we've been coming down, we saw this green. That means volume is above average. Now that we're bouncing back up, we see volume below average. That is a concern. Then sentiment, we get this once a week where now we're more extreme negative with the fear and greed gauges that we look at. Here, we're all the way down to neutral. This could be a little bit positive where we look at the legal insider transaction ratios. This is like CEOs and corporate officers, people that buy or sell shares of the company that they work for or that they own. but they have to report that. And so we get a reading here periodically. When this is coming down below this black line, that tends to be more of a bullish sign. And here's another sentiment gauge here where we're dropping below the midpoint and dropping down to 0.5%. This is according to Goldman Sachs. Then, and I pointed this out over the weekend, these are individual investors, but this also takes different sentiment in here. We're getting very low readings down here. We typically use this as a contrarian indicator when we're getting such low readings like this. You can see the couple of low times we had after that. We hit lows with the S&P and then bounced up from there. Now, we don't know if that's going to happen this time, but similar things have happened like this before. And then here's the equity sentiment indicator coming in with a negative reading after Friday. So sentiment hasn't really shifted back over to positive yet. The Ulcer Index is still giving us a very high reading. This is another sentiment gauge that we follow. It's well above its moving average. We're coming down with the VIX on a closing basis as well as with the bar chart, but we're still above 20, and that's negative. And the VIX of the VIX is also coming down as the VIX itself has been declining. We're actually starting to shift over and see momentum go down as far as the VIX. And I use a MACD to measure the momentum. We declined with this fear gauge. We also declined with the other fear gauge. So we have two up days and a little bit of fear has been coming out of the market. This is a concern, even though it improved a little bit on Monday. This is the spread between risky and not as risky bonds. When this starts going up, that means fear is increasing. Now, this is an inverted version of that same chart. We ticked back up a little bit on Monday, but we've been really coming down lately. If this continues to fall, which means fear is increasing, that's going to be more negative from a sentiment perspective with the bond market. We ticked up just a little bit with the equity put call ratio. We really spiked on Thursday, really came down on Friday, and then just went back up just a little bit on Monday. So we're actually rolling over here with our 5-day chart and our 10-day chart, and that's slightly more positive. And we're still showing the risk on to risk off ratio. It's been declining as stocks have been going down. We bounced back up both in Friday session and in Monday session. So it's improving, but not, it hasn't bounced back up enough yet for us to really consider this positive. And we're coming down with the volatility risk premium. We're actually dropping underneath the band. Then the advanced decline line, which had been holding up, even though we were coming down, this was pretty much flat as the S&P was falling. And again, that suggests more rotation, going from growth into value. We're still positive here, even though we advanced. We're above the moving average, both based on price and volume. A little bit of an improvement here with more new highs than new lows, but we're still going down with the 5-day and the 10-day averages. We're crossing back above zero with the advanced decline ratio, especially the short term, based on 19 periods. This is a further breakout. The top area, that's the same chart that we just looked at with the blue line, we're crossing back above zero here. The reason I brought this up is we're starting to cross back above zero based on volume, which is not shown in that previous chart. Then our smart money indicator, accumulation distribution, this continues to be positive. It's above the moving average and going up. We're still negative with the chicken money flow. It's improving. It actually had turned negative and we bounced up in Friday's and Monday's session, but we haven't gone above enough to turn this red line back up. So our second smart money indicator is still negative. But we're positive with our third smart money indicator, the chicken oscillator. And it's been really choppy lately, but it's above the midpoint, above its moving average, and advancing. So two of the three are positive. But that, in my opinion, is a mixed picture. We want to see the three of these smart money indicators showing the same signal at the same time. The vortex is still negative, even though the red line's coming down and the green line's going up. And I pointed this out over the weekend as well. The NYSE advanced decline line came down to its 200-day moving average, and so far has been bouncing up off of that. Can it continue to go up and get back above its 50-period moving average? And we're seeing an improvement here with the cumulative advanced decline line for the NYSE, also bouncing back up here with the regular advanced decline line, but not quite up to the 50-period moving average. Then we look at the new highs and new lows inside the S&P and take a 10-day moving average. This is still negative. This is slower. It takes longer for this to either turn negative when we were going down or turn back positive when we if we continue to go up. So this is negative when you take it all together. And we're still negative here with the 5 period moving average of the highs and lows across the Amex, NASDAQ, and NYSE. It bounced up given Friday and Monday's action, but it hasn't come back above zero yet. And we're seeing some improvement here with those stocks in the S&P above their 20 period moving averages. We came down to this 20 level. That meant 20% of stocks in the S&P were above their 20-day moving average. We are bouncing up, so we're improving, but we haven't crossed back above 50. We're also seeing an improvement with the 50 period moving average study, the 100 period moving average study, and the 200 period moving average study, but they're all still negative. And we're actually coming back above the moving average here with the S&P advanced decline line. We're improving with the NYSE common stock, but still below the moving average. And we're seeing pretty much that same thing with the mid caps and the small caps. And I've been keeping an eye on this percentage move here. Now, I measure it a bit differently. If you've been hearing about a 10% correction, that's usually from close to close. The high that we set in February to the close that we set last Thursday, that was 10%. I measure this on an intraday basis. So, what was the high on that day that we set the all-time high? And then what was the low that we've seen recently here? And it was over 10%, over 10.5%. Well, now we're starting to bounce up from this. And if we keep going up, I'll probably not show this chart for a little while. In the short term, we are coming up here, but we are still below the 200-day moving average, and we're below average with volume. Now, this is another kind of positive thing. The advanced decline ratio, we were up close to this 90% level after Friday, and we're still getting a high reading after Monday. And we're showing some improvement with the 20 period moving average of the S&P, also the 50 period moving average and the 200 period moving average. And with the boom indicator, this measures how far away we are from a 20, 50, and 200-day moving average. We're coming back up, so we're improving, but we're still extreme negative as we are with the 50 period moving average study, and we're still below zero with whether we're measuring if we're above or below the 200-day moving average. And we're showing some improvement here with some of our short-term indicators. The Stochc RSI crossed above the midpoint, is looking a little better. Williams percent are no longer extreme negative. The CCI 14 going up, but not up to its midpoint yet, and coming out of being extreme negative with the CCI 20. And the short-term stochastics, which had been extreme negative, they're no longer extreme negative. They're actually starting to go up. We're just barely extreme negative with the intermediate term. We're finally starting to turn back up here with the long-term stochastic. And again, this is a shorter term subdivision of the short-term time frame. All right, and then the force index is improving, but still negative. The condition of the short-term trend, we're actually coming above the lines. If we can stay above them, see these lines turn back up, that would be more positive. So there is some improvement there, but it's still negative. We're up into the -1 channel now with our standard deviations chart. We'd come all the way down into the -3. That's where we were looking oversold. Then we bounced back up in Friday's session to the -2. Now we're up into the -1. Intermediate term, we're bouncing up with the balance of power, but still below zero. We're turning a lighter shade of purple here with the go, no go, and we're bouncing off the lowest low value. So there is improvement here, but things are still negative. The TTM squeeze, turning the lighter shade of red, but it's still extreme negative. It's still below this black line. And here's a longer term look at that. We really came down ferociously here. It's going to take a while just to get back up and wear off this extreme negative reading. We're still moving pretty fast though with standard deviation. This doesn't measure direction, it just measures speed. And when we were coming down, that's when we were getting really high readings with standard deviation. Now that we're bouncing back up, that's why we're seeing this dropping off. It just takes the last 10 periods. And we're improving, but still negative with the ease of movement. We're still negative with the Arun indicator. We're below zero when we look at the oscillator down on the bottom. And we're actually crossing above zero now with the S&P McClellan oscillator. That's actually turning positive. So we're barely starting to go up based on price. And now after Friday, we turned up based on volume. And we're even seeing a little bit more of an improvement here after Monday. So this has actually turned back positive now. And we're above zero and going up with the NYSE McClellan oscillator, even though it's really hard to see. We're trying to turn back up with the summation index based on price and volume for the NYSE. The swing trading oscillator was a little bit positive after Friday. It actually turned up. Now it's looking a little bit more positive. We're going up based on price and volume, and we're actually crossing above zero here based on volume. But on a momentum basis, we're negative, but we're possibly still extreme negative. We've come down to this green line with the PMO. We're still declining based on price and volume here, even though these are trying to turn back up. They haven't crossed back above their moving averages. Seeing an improvement with the PMOs that are rising after giving us an extreme negative reading. The buy signals are turning up, and we're flattening out with the PMOs that are above zero. And the condition of the intermediate term trend is improving, but we haven't even come back up to the red or blue line yet. And we're still below all the moving averages here. Now you can see where we hit the 200-day exponential moving average. That was the high, and that was right at around 5,700. You can see how important these moving averages are and acting as overhead resistance. If we can keep going up, then it'll be the 200-day simple moving average, which is much what most folks focus on. And then we have various other moving averages that we would have to break through to get even more positive here. So we'll keep an eye on this. And then we're the anchored moving averages too. I was pointing this out about a week ago. We finally broke below this blue line, which is an anchored moving average going back to the low set a year ago, April. Well, we're coming back up, and now this is acting as overhead resistance for the time being. And we're still neutral with the Elder's Impulse system for the S&P. We're now positive on the daily side with the parabolic SAR. We saw enough of a bounce over the last two trading sessions to put a dot underneath. So we see the summation index is turning positive and the parabolic SAR is turning positive. And for me, those are two primary indicators that have now switched positive. We're turning up, but we're still extreme negative with the slope oscillator. This is short term. Trying to turn up, but still negative and very extreme here with the MACD. So all of our oscillators in the short term are trying to improve, but they're really, really extreme negative. We're still going down with our long-term oscillators. And the Copic curve trying to turn up, but still negative. And then this next chart just shows you how deep we had come down here with the Copic curve. It was extreme negative as well. The Sean trend meter is no longer extreme negative. We were camped down here in this pink area for a while. We're actually starting to go back up. We're improving, but still below 50 with the money flow index. So that's negative. Just about up to 50 with the ultimate oscillator. That could be turning positive. We're coming up, it's still below 50 with the RSI 14 and the RSI 9. And we're seeing an improvement with the bullish percent index. We're actually turning positive here. It crossed back above its moving average. And we're seeing an improvement here with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. It had actually come down to this red line, which was an extreme negative reading. And so all of these are showing some improvement here. We have not had a signal yet with the mass index. We've had two out of the three criteria that have been met. We're waiting for the third one, which means we'll come down to this red dashed line again. And that would produce a buy signal because it was a decline here that actually put this indicator in motion. And we don't have a buy signal yet with the Pring bottom fisher. We're still above the 50% retracement level with our Fibonacci chart, and we're actually using this 61.8% retracement level as overhead resistance. We were not able to close back above that. This is another overhead resistance area that we want to keep an eye on. But this is positive. We actually were able last Friday to get back above this pivot level on a weekly basis and close above it. That kept us more positive longer term, and we're still above that with the advance that we saw on Monday. And we're showing a little bit of improvement here with the Heiken Ashi. It's looking a little more positive. We're turning positive here with the Kegi chart. It's black and pointing up, but we're still negative with the Renko chart, and we're still negative with the three-line break chart. And we had some new X's drawn in with the point and figure chart. Three green ones here. We don't have a signal now, but this is looking better. Long term, we're showing an improvement with our 150 moving average here. We had come down and actually become extreme negative. Now we're bouncing up out of that. We never did get extreme with the 200 period moving average, but that's also improving. And we're still seeing the same thing here. I don't know if these charts aren't being updated or what, but we're negative in the short and intermediate term with the S&P mid caps, small caps, and the triple Qs. And bonds are positive in the short and intermediate term. We're back to being positive across the board with commodities. The dollar is still in a downtrend in the short and intermediate term. All the sectors ended up being positive, with real estate actually leading the way higher. That's more of a defensive area. Energy, another defensive area. See, we're not really seeing outperformance by growth here. Down at the bottom, discretionary was up, and that's kind of a pseudo growth area, but we want to see that doing better. Communication was not one of the better performing areas, nor was tech, even though these are the big three growth areas that we want to see doing better. And even with the update, they were at the bottom of the list. And we saw an awful lot of green or blue here. And we read this from the bottom up, where we had a BPI crossover with the communication sector above 50. That's more positive. And then we had the NASDAQ go above 17.8. Then it fell down below 17.7. Then it worked its way back up to 17.9. It was all over the place there. We are seeing some constructive things, though, but they're still negative. Like the BPI cross above 30 now with the tech sector. It had become extreme negative. Healthcare is going above 50. Be careful of that. That's more defensive. Utilities, which is also more defensive, had a bullish MACD crossover. Energy, another defensive area, is having a BPI cross back above 30, as are the utilities. They're showing more strength. They're actually crossing above 70. And now you could make a case, and I point this out every time. Utilities historically have been defensive. These are what widows and orphans get into because they pay high dividends. Well, this could be considered a growth area because of the massive amount of electricity that is going to be required for all this crypto mining and AI and electric vehicles and so forth. Then materials, which is driven more by what's happening in the economy, it had become quite negative. It had a BPI cross above 20, and then the S&P didn't stay there, but it did get above 5,700, and briefly there, the Dow was above 42,000. Okay, so we're coming right back up to the 200-day moving average with the Dow. Now, of the major indexes that I follow, the Dow was the last one to lose its 200-day moving average. We want to see that retaken if possible. That could help things turn more positive if the Dow could get above this. If we've hit resistance now and start going down, yeah, that's going to turn things more negative. And we're still neutral with the Elder's Impulse system for the diamonds, bouncing up off this S2 level, but a long ways to go to get back to the 200-day moving average with the NASDAQ, as well as the NASDAQ 100. We're neutral with the QQQs when looking at the Elder's Impulse system. The momentum is improving, but still negative for the NASDAQ 100. Small caps, which are just not doing very well. We're about ready to see a death cross here, where the 50 period moving average is getting ready to cross below the 200-day moving average. And then we look at another small cap index, the Russell. It's improving here with the RSI, getting close to a death cross here, seeing an improvement as far as momentum, but still negative. And we're still neutral, though, with the small caps when looking at the Elder's Impulse system. And the mid caps also haven't been doing all that well, even though the last couple of days have been good. They're not quite as close to a death cross, and they're bouncing above this S2 support level. That would be more positive, of course, if we keep going up. And we're still neutral with the Elder's Impulse system for the mid caps. Financial sector, after really taking a beating, it has been doing quite well lately, but it's still under its 50-day moving average. And the bank ETF, been watching this because we're below the 200-day moving average. That's also acting as overhead resistance. And the Wilshire 5000, which is a broad market measure, is improving, but still below its 200-day moving average. Same thing here with the total US stock ETF. Has not surpassed the 200-day moving average, where the FANG index has. And that can be encouraging because these are the mega caps. So we closed right a little bit above the 200-day moving average on Friday, and we're still above it after Monday. So that's holding up a bit better there. And we're coming down a little bit with the spike when we look at the staples to tech ratio. When this is coming down, that means staples are underperforming. Well, staples were outperforming enough to almost give us a golden cross here with this ratio. We're going to need to see this come back down if we're going to turn more positive for the S&P. And Amazon was up, actually was down over 1% and still below its 200-day moving average. Apple was up 1/4%, still below its 200-day moving average. Meta was down almost 0.5% below its 50-day moving average. Google was down almost 0.75% below its 200-day moving average. Microsoft was virtually unchanged and actually in a downtrend. Nvidia was down 1.76%, and we're getting ready to see a death cross here as well. Tesla was down 4.79%. So you can see the mega caps really didn't do all that good in Monday's session. They did well on Monday, excuse me, on Friday, but they didn't do well on Monday. And Netflix was up 3.49%. It's actually coming back up to its 50-day moving average. And we're still seeing a little strengthening here with the short-term correlation between world stocks and U.S. stocks. And it's that U.S. stocks, the red line, they've been going down and world stocks have been holding up. That's why we were seeing this relationship actually deteriorate. Longer term, we're still showing a drop-off between U.S. and world stocks. Oil was up barely here, but it's getting up into the mid to upper 60s now, and we're watching that mainly for geopolitical reasons for what's going on in the Middle East, but it's not spiking up the way it has in the past. And the dollar ended up being down slightly, even though it's a plus here. This trades 24 hours a day. It's really been getting hit hard lately. And we were unchanged with interest rates, with the 10-year yield, unchanged here with the 10-year based on price. And we're seeing an improvement with our growth to value ratios, but we're still negative. With the Qs to S&P, the moving average is still going down, as it is with the discretionary to S&P and the large cap growth versus large cap value. So improving, but still negative with the large caps, mid caps, and small caps. So what's the outlook for Tuesday? We're still negative in the short and intermediate term. We're still below the 200-day moving average on the S&P 500, and the long-term support, that pivot chart on a weekly S&P 500 basis, that is still holding as support for right now. We're going to get housing starts and building permits, which are considered to be leading indicators, import and export prices, industrial production, and capacity utilization. Not a huge day as far as economic reports. And we want to keep an eye on what's going on in the Middle East, what's going on with the executive orders and Doge cuts and the trade wars between Canada and the US and Mexico and possibly Europe coming into the party as well. And then on Wednesday, not really big as far as the economic reports, but that's when the Fed is going to meet. And then we'll get initial jobless claims on Thursday. There'll be no reports on Friday. And this red box, this is the next big thing to happen. We really don't have anything major coming out on Tuesday. Seasonality, we are positive for March 18th for the Dow, S&P, and NASDAQ. And we're in this time of options expiration where we tend to be up 64% of the time and down 35% of the time. Okay, that equals 99%. Let's say 65% here that we're up. And then seasonality, whether you look at the solid line, that's fairly positive for right now. Or if you look at a post-election year, we still have a couple of days of positive seasonality before it starts to turn negative again. And we're in the second half of March, which tends to perform okay, but the first half of March was dismal. And this shows just things flattening out before we possibly could get set to go higher later in the year. All right, so we're mixed as far as our smart money indicators. Positive with accumulation distribution and the Chaikin oscillator, but we're still negative with the Chaikin money flow, even though it's improving. And we're still negative with the bullish percent indexes. Actually, I take that back. We're actually positive now with the S&P. We came back enough to cross above the moving average. We're still negative on a momentum basis. And then I'm adding this one here, the long-term special K. I'm not showing that chart right now because we only get maybe one signal a year or something from that. So I'm just going to list it here. We're below the moving average, and that's negative. The moving average studies are improving, but they're negative. Ease of movement, money flow, ultimate oscillator, all improving. We're just about ready to go positive with the ultimate oscillator, but these are still negative. The vortex is negative, but improving. And the momentum for the NASDAQ 100 is also negative, but improving. And then the positive things are that on a longer term basis, when we use moving averages, growth is still outperforming value. Just shorter term and over the last month or so, it's just been taking a beating, fierce beating. And the equity put call ratios are actually, these should be going down. I forgot to change that from up to down. Sorry about that. And we're positive now with the S&P and NYSE McClellan oscillators and summation indexes. Can we hold on to that? Parabolic SAR has now turned over and is looking positive. The financial sector had a good day over the last couple of days. The recent weakness is causing a bit of a concern. Even with the bounce, the bank ETF is still under its 200-day moving average, and the Swindle Trading Oscillator is pointing up based on price and volume. So our conclusion, we're still negative in the short and intermediate term. We're mixed positive in the long term. It'll be more positive if we can get back above the 200-day simple moving average. And I just asked the question here, will the improvements continue? Is this a dead cat bounce to wear off some extreme negative conditions before we get set to go lower? Or is this the start of a bounce that keeps going? In the short term, we're negative and still bouncing from being oversold. That's the same thing that we're seeing in the intermediate term. And we're seeing some improvements in the long term, but we still need to recapture the 200-day simple moving average. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.